I'll explain in a minute. The actual process I go through does get slightly more complicated. Okay, so to Paul, to your point, could somebody do this? Yeah, absolutely. You can go to Portfolio Visualizer and you can actually run this five-factor model on US funds, and you can filter on, for example, an R squared value that's high enough that you're only going to get index funds, not active funds. That's why I have that highlighted. And then you can click on this little Excel box and you can download all of the data. You can go get the 4,000, what is it, 2750 funds here, and then start having a great time. So it's definitely doable, and the interested student it can have at it and have fun.
Yeah, we have to remind them that you are volunteering your time. And there is obviously a ton to get done without doing that extra work. But I think it's great that they can do it on their own.
Yep. So, when I do that fund analysis, it is more than just the spreadsheet, as you well know, because then I go to Morningstar for all of our candidate funds and I look at the expense ratios, I look at the number of holdings, the number of companies that are in each fund, I look at the turnover, I look at the R squared out of the regression analysis, I look at the parent company, I look at the methodology of how the fund is managed. And it it's very iterative, as you guys know, because I've presented you, I think, with three sets of recommendations before we got to the final. And in fact, if you look at the real process, it's got lots of steps, and
Oh,
there'd be arrows going back and forth all over the place on this chart if I really described them all. So it takes some time, but it gets us to the point, though, that we can update the website and provide you with the new recommendations, and that's where I want to go next. Okay, so how do you find these recommendations on the website? It's pretty easy. You go to the top of the website to the pull down that says portfolios, and right under that, there's this 2025 best in class ETF updates. And you just click on recommendations right there, and that'll take you to the update page. And you'll see on that page that we've updated the portfolio configurator and the Merriman Aggressive glide path, target date glide path asset allocation calculator as well. We've also updated the M1 pies to the extent that that's possible because they don't have one of our funds, but they have all of the others. And what I've done here is for the changes, they're in highlights. And I really like to keep as few changes as possible, but I also am going to make a change when it's justified. So for example, US large cap blend is the same that we had before, AVUS. And if you look at it, this category has the least variability of most of the categories because this category really consists of large companies in the United States for the most part, in S&P 500 funds for the most part, and they just don't vary very much and they're very inexpensive. The fund that we recommend, this AVUS, is actually more diversified than an S&P 500 fund. But for that diversification, you also get a little bit higher expected return because the way Avantis runs the fund, they disproportionately weight companies of higher quality. And they also tilt just a little bit towards small in value. So that's why it's there. But in terms of differences, it's a 0.9% relative return in this category compared to 0% for the Schwab large cap blend. This 0.9% is relative to the other things that are in the box that is bounded by black, which is just the large cap blend category. And so the lowest one there is this Schwab large cap SCHX. If we look at the next category where we have a change, where Avantis US large cap value replaced the RPV fund, it actually has a lower expected return than RPV. So why would I have made that change? The reason I made the change is to be more representative of the category. So if you compare the large cap value space with RPV. RPV is really more of a mid-cap value fund. And so that's part of the reason it has this higher expected return. And I'm being transparent so that if people want to use it, they can. But to be fair, I'm also adding in some other mid-cap value funds that you might choose among. There's an Avantis one that has a higher expected return, although for a shorter history than the Investco S&P 500 Pure Value. And there's also a Vanguard fund listed there that had a little bit lower expected return. So you have a choice here, but we're making that change because it represents the category more accurately. And if you go with that, it's going to more likely, it'll have a higher likelihood of following the results that show in Daryl's charts.
You know, Chris, it's really interesting as I look at the large cap blend. And when you look at the total market index for Vanguard, there's a 0.1% versus for the S&P 500 from Vanguard, a 0.2%. And that means I would expect the S&P 500 to make a small difference. And this is coming out of your study. It is also interesting to note that from 1928 until the end of 2024, the advantage to Vanguard, I mean, to the S&P 500 was in fact about 0.1%. And so it is looking very much like the history of those two equity asset classes. And I might also add that in conversations with people at Avantis, the question is with their studies, how much more should the AVUS make because it has more value and average size companies are smaller. They think it's somewhere between 1 and 1.5% without taking fees into consideration. So again, it looks a lot like the conclusions that you have come to with your analysis.
Well, I'm glad to know that we can triangulate and agree with multiple different ways of looking at it. They should agree because they're all based on the future looking at least a little bit like the past. Yeah. So the next category down is U.S. small cap blend, and we are making a change there as well. And you can see the Avantis U.S. small cap equities AVSC as a replacement for the IJR fund, and the difference there in expected return for the history that is in common since February of 2022 is goes from 1% to 2.8%. So it's almost a 2% advantage. And so even though the history isn't as long, I felt like that was pretty strong. But if you're in, say, DFAS or you like DFA instead, its factor predicted expected return over that same time frame was 2.4%. So pretty close. So, you can, that's what I like about putting those percentages in there is that lets people see, are they similar? Are they way far apart? Are they close together? And the larger the market, the larger the category, the closer I expect them to be. So then there's a number of categories where our recommendations stayed the same. Two of them worth just discussing briefly would be U.S. small cap value. It's not the highest factor predicted return in that category, the AVUV fund. The highest predicted return there is for RZV, which we have recommended in the past, but RZV holds a lot of micro caps. And that makes it very volatile, and it has underperformed for long periods of time. So in that category, I favored AVUV because it's had a higher return per unit of risk. And RZV has also historically had times when it went through periods of large negative momentum that dragged its return down. So that was a combination of not wanting to whipsaw our investors, but also wanting to recommend to them what we believe, for a variety of reasons, still has the highest likelihood of helping them out. Yeah.
So, Chris, I noticed in that table you showed us that Daryl had brought up that in those small cap blend, the one right at the bottom with the worst track record was the micro.
Oh, the microcap IWC. Yes,
Yeah.
right here. Yeah.
So I was curious when I saw that whether if we talk about size, I can imagine somebody asking, wait a minute, if there's a premium for size, why wouldn't the smallest give us the biggest premium? And I don't have the answer. Do you?
Well, the way I like to think of it is when you're buying these funds, you're always buying a multi-factor fund. So on the one hand, yes, the Russell Microcap IWC is going to have more exposure to the size attribute, to the size factor. But once you get into that universe, are you going to have a smaller selection of companies with good profitability?
Right.
Are you going to have a smaller selection of companies with good investment? Are you going to have a smaller number of companies with a favorable value nudge, even if it's just a nudge, because this isn't a value category, right? So I think whenever you reach extra far for one of these attributes, you make the sacrifice of not being able to get as many of the others. And so and you also tend to end up with a portfolio that is more volatile. And because it's firing on one or two cylinders instead of five or six, it's less consistent in when it delivers that premium. Yeah. So I think the
So
IW
it's kind of a diversity argument,
diversification argument. Yes,
diversification argument. Yeah.
absolutely. Yep, that's absolutely right. And I think there's an opportunity in the small category to get a wider range of diversification than there is in the micro cap category. Yeah.
Right.
So that was the small cap value. The international large cap value also is not the highest factor predicted return. I went with DFA's DFIV. That was our previous recommended fund compared to EFV, which previously had been recommended by us. But again, if I extend the analysis here, the factor regression analysis, to a longer period of time, then DFIV actually has the higher expected return. And since EFV has come in and out, I didn't want to whipsaw investors, and so I stuck with the DFIV, and I believe it has better methodology and other reasons to stick with it. So, you can see there's a little bit of art in here. It's not all just numbers, but if you just like the numbers and you want to go with that, I'm transparent. You can go pick EFV. International Small Cap Blend, we are switching from FNDC, which actually, even though it's called an International Small Company Fund, recently has been sitting more in kind of a mid-value space. We're switching to AVDS, which is a new Avantis International Small Cap Fund that better represents the category. And we do like the methodology of Avantis. Now, the one thing people may want to be aware of with AVDS is that it's relatively new, still smallish. So in trading it, you'll want to set limit orders probably in terms of just watching for bid-ask spread. And then finally, the Avantis Emerging Markets replaces the EEMS. It's significantly less expensive and over the same time period had a significantly higher expected return. So this one seems like a fairly straightforward change. It's got more and smaller companies with better financials and higher factor predicted expected returns. So those are the changes. The rationale and summary and some facts are on the website. And probably the other cool thing to just check out quickly is that if you go to the portfolio